Welcome back to the channel. First video back of 2026. And after taking some time to unwind, a lot of volatility, a lot of questions that Canadians are facing that we've been getting a lot of emails about, especially around mortgage renewals, what to expect, how to plan, more importantly, what to expect when it comes to rates. Ultimately, a lot to really unpack, especially for Canadians that are looking at their mortgage renewals, looking at their options. There is a big question about, are we going to see rates lower, stay the same, or potentially higher in 2026? This week, I want to take an opportunity to share thoughts and opinions on that. Once again, thanks for stopping by. If you have not yet subscribed, please consider smashing that subscribe button, hit that notification bell so you can stay up to date with all the mortgage updates, as well as don't forget to leave your thoughts, questions, and concerns in the comments section below. And let's get right into it. So first and foremost, I want to start off by talking a little bit about the CPI data that came out earlier this week. It's a mixed bag. Ultimately, CPI headline inflation came in at 2.4. That's a little bit higher than November, so December came in at 2.4, and that's obviously not a move in the right direction. However, a lot of that is to do with the HST holiday that we saw last year in December. So if we look at month-to-month change, ultimately there are some base year effects that are obviously playing into that. So the other thing that's super important to understand is that core measures, the medium and trim, the numbers that the Bank of Canada pays really close attention to, actually have pulled back substantially. And that is actually good news for the Bank of Canada. But once again, it's super important to understand something that we've talked about on the channel at great length, is that the Bank of Canada, over its most recent press conferences, has alluded to the fact that they believe that they're done with cutting rates and that the Bank of Canada policy rate is at its neutral territory, meaning that, basically keeping the rate at this point won't stir the economy too heavily and obviously won't create more inflationary pressures. That is obviously what they believe, and obviously the data coming out of Stats Canada is what the Bank of Canada is going to use to make their decisions on what happens next, even though as Canadians we see on the actual ground floor when we're out there shopping that things are a lot more expensive than what the Stats Canada maybe projects that things are. But once again, this is what the data is for the Bank of Canada, and we have to take that with what the Bank of Canada will be doing next. Now, ultimately, the Bank of Canada is sitting at a position right now where it's going to wait and see. And as we look at this data for the month of December, I don't anticipate that the Bank of Canada is going to be making a move on January 28th. That is the next time the Bank of Canada will meet. I think we can expect a pause once again. And obviously there's a lot of conversation right now with banks like RBC and other major banks pointing to the potential for, on the variable side, obviously the Bank of Canada hitting the pause button or maybe hiking rates in 2027 if we see inflation continue to tick back up. And another super important thing to really keep in mind when we think about the Bank of Canada, a lot of Canadians are super attuned to what is happening with the Bank of Canada, especially because they're planning their mortgage decisions, either purchasing or restructuring or refinancing their mortgage based on what the Bank of Canada is set to do. Now, once again, it's important to understand that the Bank of Canada, when they make a move to their policy rate, it doesn't mean that fixed rate mortgages move with the Bank of Canada. There are two different barometers, right? Bank of Canada means that whatever they do, if it goes up or down their policy rate, that impacts variable rate mortgages, adjustable rate mortgages, lines of credits that are based on prime, right? Prime is what the lender, your bank, charges for their money, right? So just because the Bank of Canada is sitting at 2.25 or 2.5%, or they move it up or down, right? It doesn't mean that fixed rate mortgages will move lock and step with that. And basically, just to talk a little bit about what's moving the bond market right now, and obviously if you've paying attention to it, we've seen that the 5-year Bank of Canada bond, obviously these treasuries, the bonds in Canada ultimately have moved up over the last little while, as there are a lot of geopolitical tensions, right? Ultimately, what's happening with these tariffs, there's still the uncertainty. Trump continues to wage war on these other countries in Europe, as well as the conversation around Greenland, and ultimately how the markets are reacting to that. This entire volatility will move the bond markets here in Canada, and ultimately what we can look at is what will happen in the next little while. So what does all this mean, right? So when we think about it in a nutshell, right, we have to understand that right now, if bond yields continue to move onwards and upwards, that maybe the lower rates that we experienced in 2025 might be, behind us, right? We may not see a lot of these better looking rates come in 2026. Now, that's not to say this is concrete. Once again, as the data shifts, so should our sentiment. But once again, because of all this volatility, Canadians that are maybe on the fence or holding tight or haven't initiated their mortgage renewal, maybe they know their mortgage renewal is coming up in the next little while, but they haven't got any correspondence from their bank. They're just waiting to see what happens. It may not be the best approach, because what if the rates that we saw in 2025 were actually better than what you could be getting in 2026? And that literally is the question. A lot of banks like RBC saying, look, maybe we're not going to see any more rate cuts. Maybe we're going to see fixed rates move up as this volatility continues to wreak havoc on the bond market here in Canada, driving those fixed rate mortgages up. I mean, the case in point for a lot of these Canadians that are renewing their mortgage, it's important to really understand a few nuances. If you took a mortgage or renewed your mortgage in 2021, you took a 5-year term, you're coming up for renewal right now. Most likely, if you're with one of the major banks or even a broker-friendly bank, you would have had a rate that probably was at 2% or much lower than that. And now you're going to be renewing into rates that potentially start with a 4, right? We have seen those bonds tick up. We have seen some of the major banks move those fixed rate mortgages up. But on the other hand, if you took a mortgage out in 2023 and you took, for example, a 3-year term, well, you're coming up in 2026, and chances are you had a rate that started with a 5 or greater at that particular point in time. And now, if you're renewing with a rate with a 4, well, you might be saving money, right? So there's two tails really happening right now, and that's what we're starting seeing. The payment shock for those that got a mortgage 5 years back in 2021 when rates were super low, effectively some of the lowest rates we've seen in a very long time, as opposed to those that renewed in 2023 at some of the highest rates that we've seen in a very long time. So once again, if you're really thinking about your situation, your mortgage, what you plan to do with it, two things. One is you can download our app in the description box below. It is a free tool or resource that can help you sort of look at your refinancing options, what rates look like today, and what those payments could look like. And one thing that we're noticing right now for a lot of Canadians, especially those that maybe haven't gotten a pay increase or haven't really seen their monthly budget, get better, right? It's obviously with the cost of goods and services, gas, food, so on going higher, a lot of that disposable income is going to the wayside. And a lot of Canadians are looking for ways to sort of make their monthly payments, their obligations a little bit closer to what they were paying, or maybe, paying out some of those debts. And the best way to do that is to obviously look at your finances, speak to your mortgage professional about options, maybe consider re-amortizing that mortgage back up to 30 years if you're eligible to do that. Now, once again, this obviously will require you to pay more interest over the life of your mortgage. If you're taking a shorter term product versus a 5-year product, you do have the ability that once that term expires in the next little while, right? So you're taking the mortgage now, 3 or 5 years from now, you can always look back at it and restructure, re-amortize that mortgage back down to sort of offset some of those costs. Once again, this is a strategy. It doesn't mean that it's one that will play out for all Canadians. But once again, we look at the average Canadian who's looking at their payment structure. They're looking at those overall costs and trying to figure out a way how to save a little bit more money, or at least not to increase their budget monthly, especially for those that are stretching it already pretty thin. So once again, I think it's super important, and one that we've been telling all our clients is, look, if your mortgage is coming up for renewal in the next 3-6 months, reach out to your mortgage professional, have a conversation with them. Once again, within 90 to 120, 130 days, you can securitize a rate. If your mortgage is coming up for renewal with your lender, you can ask for an early renewal, because let's face it, at the end of the day, we don't know where fixed rates are headed. A lot of people tell you, hey, rates are going to come down in the near future. We don't know that, right? There is no substantiating data that can support that. We don't know that at this current moment. And what we have to really consider is, will the Bank of Canada be cutting rates? Will they actually execute? Will we see a rate cut in 2026? If some of the major banks' predictions are correct, we may see even a rate hike on those variable rate mortgages potentially in 2027. So if you are hoping or planning for lower rates in the future, it may not happen. And once again, you want to plan ahead. Today might be the better option. Once again, we don't know what the future has in store. Anybody that tells you they know what's coming definitely does not. Nobody has a crystal ball. And once again, with all these geopolitical tensions, what's happening between, the US, what's happening between Canada, obviously the most recent conversations at Davos between Prime Minister Mark Carney and obviously Donald Trump's wreaking a lot of havoc on these markets. So it's super important to just plan ahead, and that's our advice for this week as we kick off 2026. And more importantly, we'll be back next week with an update on what's happening with the Bank of Canada. So make sure you like, you share the video, subscribe to the channel, and we'll see you all next week.